So we've gone from TSSA, safety software. Now we're going to talk about money. This is an interesting topic. I've gone through a significant change recently where having some of this information at hand might have helped out. So we have Daniel from Segal. Where's Daniel? Don't see him back there. Did I say Segal right? Segal. I wasn't sure if you were like Steven, like the ninja dude, or Segal. Okay. Anyway, so Daniel's a financial wizard, I understand. You're able to take the money that we pay to government and some of the capital gains changes and estate planning, what have you, and you're going to be able to keep all that money back in our pockets, right? Is what I understand.
That's right. Yeah.
Okay. Again, it may not seem like an interesting topic, but for me personally, this was something that came up very, very quickly, and it was an opportunity to save a bunch of money, so that it didn't go to the fantastic government with the way they spend their money. So again, it's probably something you may want to pay attention to. Things happen really quickly. So again, guys, Daniel, thank you.
Great. Good afternoon. My name is Daniel Wilson, and I'm a tax partner at Segal GCS LLP. And for those of you who are not familiar with our firm, we're a mid-market accounting firm in Toronto, and we serve a lot of owner-managed businesses. I wanted to say, first of all, it's a pleasure to be here for the ORAC Fall Forum. It's funny, I was just here a couple months ago, so our firm had our summer event in this very area. So I feel like I'm a regular now at Woodbine. So ever since the Trudeau government came into power, there was an annual exercise where accountants, individuals, and the business community at large would speculate, when are they going to pull the trigger on the capital gains tax? Because the first thing the Trudeau government did was they increased the top marginal rate by 4%, from 29 to 33%. That's why Ontario, if you're on the highest rate, you have 53.5% tax. So every year there would be all kinds of planning, rumors, speculation. Nothing happened from 2016 to 2023. Well, this year, when a lot of people weren't expecting it, they did the unthinkable and they increased the capital gains inclusion rate. So there are wide-ranging implications. I mean, it sounds basic, capital gains, but it encompasses so many different areas in tax. So I'm going to discuss some of the implications, and I'm also going to discuss the lifetime capital gains exemption, which has been around for a while but received a boost in this year's budget. In addition, I'm going to discuss the new Canadian Entrepreneurs Incentive. And at the end of the presentation, I'll take your questions. Okay, so let's start big picture. The 2024 federal budget came out on April 16, 2024, right in the heart of the busiest time of year for accountants. The effective date for the capital gains change was June 25th, 2024. All capital gains realized after that date would be subject to a 67% inclusion rate instead of a 50% inclusion rate. For over 2 months, there was all kinds of planning that was undertaken to lock in the capital gains at the 50% inclusion rate. The crazy part is that legislation was not actually issued until June 9, 2024. Everyone was essentially in the dark on what this would look like, and we had to rely on high-level commentary, high-level comments in the budget commentary. If there was one positive that came out of this change, it was a $250,000 personal annual exemption for individuals. And I'll discuss this shortly. Okay, now the budget document indicated that only 0.13% of Canadians with an average income of $1.4 million were expected to pay more taxes on their capital gains as a result of the changes. So this represents just over 50,000 Canadians. That number appears way too low. What happens to someone who passes away after June 24th, 2024? They may hold illiquid assets, such as real estate or private company shares. If they acquired life insurance to fund the estimated tax on death, the life insurance proceeds might not be enough. Think how common it is for people to own second properties, whether it's a cottage or a condo in Florida. those capital gains could easily exceed $250,000 in a given year. If you sell shares of a private company, you could be looking at significant increases in taxes if the value of your company is high. Ever since the budget, I've had many clients contact me about leaving Canada. This change to capital gains, that was the last straw. Now, when you leave Canada, there could be a large capital gain since you're deemed to dispose of all your worldwide assets at fair market value. So to the extent you have unrealized gains, they all get triggered at the point of departure. I like this slide because it shows you the history of capital gains from their first introduction in 1972 until now. Now, when you look at it, for most years, the 50% inclusion rate was in effect. You'll notice that the 1990s had a very high rate of 75%. In fact, there were a lot of entrepreneurs who were leaving Canada, and it was the Chrétien government under Paul Martin that ended up bringing it back down to 50%. Now, in terms of actual rates, Ontario resident individuals have now seen an almost 9% tax increase for capital gains that exceed $250,000 a year. The tax increased from 26.77% to 35.69%. Now, keep in mind that these tax rates apply to Ontario individuals with taxable income over $246,000 in 2024. Now, on the corporate side, for Canadian-controlled private corporations, CCPC for short, Ontario companies have seen an 8% tax increase for any capital gains realized after June 24th of this past year. The tax rate increased from 25.09 to 33.45%. As a reminder, capital gains are taxed and treated as investment income in a corporation. There's been no change to the taxation of active business income. So as I mentioned earlier, the impact of the change to the capital gains tax rates impacts many different areas. For this presentation, I'm going to focus on these subjects listed on the slide. Okay, so now we have a new section of the Income Tax Act that provides an exemption for the first $250,000 of capital gains realized by an individual per year. This exemption is based on gross capital gains and not the taxable portion. In a move to soften the blow, the government has provided a full $250,000 exemption for the period from June 25th, 2024 to December 31st of 2024. Any capital gains up to $250,000, the inclusion rate is 50%. Any capital gains in excess of $250,000, the inclusion rate is 67%. Now, this $250,000 exemption only applies to individuals, graduated rate estates, which refers to the first 36 months after an individual's died, and qualified disability trusts. It also applies to gains allocated to individuals from partnerships and trusts. Now, the $250,000 exemption is calculated by, you start off with your capital gain in the year, and then you subtract a number of items. One of those is current year capital losses. Another is capital losses from prior years that you've carried forward. Third is capital gains from one of the lifetime capital gains exemption, employee ownership trust, and the Canadian Entrepreneurs Incentive. Or it could be an amount used for the stock option deduction. To illustrate, let's use a simple example. An individual realizes $600,000 of capital gains after June 24th of this year. They also incurred a $200,000 capital loss. Once you deduct the $200,000 capital loss from the $600,000 of capital gains, you're left with $400,000 of capital gains available for the personal exemption. The first $250,000 of capital gains will be subject to the 50% inclusion rate, so we like that. The remaining $150,000 of capital gains will be subject to the 67% inclusion rate. Okay. Let's use the same numbers as the previous example. However, we'll now include a $100,000 capital loss from prior years that can get applied in 2024. This leaves an individual with $300,000 of capital gains available for the personal exemption. The first $250,000 of capital gains will be subject to the 50% inclusion rate. The remaining $50,000 of capital gains will be subject to the 67% inclusion rate. So basically, it doesn't matter what year the capital loss was incurred, it gets applied on a grossed up basis. Let's take a look at an example of an individual that claims the lifetime capital gains exemption. In prior years, $970,000 of the CGE was claimed. Before June 25th, 2024, $50,000 of capital gains were realized on qualified small business company shares. After June 24th of this year, $100,000 of capital gains were realized on QSBC shares. So prior to June 25th, 2024, the maximum lifetime capital gains exemption was $1,016,000. We need to reduce that by the $970,000 of CG that was claimed before 2024. This leaves about $47,000 of CGE available on January 1st, 2024. Therefore, when we look at the $50,000 actual capital gain prior to June 25th of this year, only $3,164 will be subject to tax at the 50% inclusion rate. The 2024 federal budget increased the maximum lifetime capital gains exemption to $1,250,000. This creates an additional $233,000 of additional exemption starting June 25th of 2024. Since the actual gain was $100,000 after June 24th of this year, the entire amount can be sheltered by the CGE. Okay, so everyone's probably heard the concept death and taxes. Well, they definitely go together in the tax world. When an individual dies and assets are not going to a surviving spouse, there's a deemed disposition of all property at fair market value, similar to when someone leaves Canada. This triggers unrealized capital gains on all property. If you have capital losses, these get applied against capital gains. If there are still capital losses remaining, these get applied to other income in the final return. If you have remaining capital losses after that, you can then carry them back to the immediate preceding year against any other income. The same concept applies for capital losses that are carried forward from prior years. It's important to note that net capital losses will be applied in the previous year. This means that under the new 67% inclusion rate, there will be more capital losses because you gross it up that are available to offset prior year's income. So let's look at another example. This one is a taxpayer who dies in 2026. There's $100,000 of capital losses available after applying against all capital gains in the year of death. There's also $50,000 of net capital losses that are carried forward from prior years when the inclusion rate was 50%. In 2025, just for simplicity, we're assuming there's $200,000 of interest income. So the net capital loss amount for 2026 is $66,000, which gets added to the $50,000 net capital loss from prior years. When you carry these amounts back to the 2025 tax year, you can reduce net income from $200,000 down to $84,000. The bottom line is that a capital loss in the year of death will now save more taxes than it did previously. So when you think about stock options, you wouldn't expect it to be impacted by a change in the taxation of capital gains. However, the tax treatment of stock options mimics capital gains if certain conditions are met. The key change here is the stock option deduction, which was 50%, will now be 33%. The deduction is available if the exercise price is greater or equal to the fair market value of the underlying shares when the stock option agreement was entered into, also known as the grant date. If we're dealing with a CCPC, the shares must be held for at least 2 years prior to a disposition once the options are exercised. If that's the case, it doesn't matter what the exercise price is. So it's providing relief for CCPCs. Now, since individuals have a $250,000 capital gains exemption each year, they can use the entire limit to claim a 50% stock option deduction. Anything above, so basically, if an individual stock option benefit exceeds $250,000, the deduction then gets limited to 33% over this limit. So the way to think about this is the $250,000 annual limit is going to be shared between capital gains and stock options. You don't get two separate limits for each type of income. So it's important to decide which income will get the $250,000 limit, because capital losses can only be applied against capital gains. Stock options are taxed as employment income. So if you will have stock option, or if you have capital losses in the future, it's better to use this exemption on capital gain, on stock option income. These capital losses, you can carry them back 3 years to offset prior year's capital gains, and it can also be carried forward to offset future capital gains. Okay, now capital gains reserves come up fairly often in my practice. Anyone familiar with the concept of a capital gains reserve? Okay, so what it allows a taxpayer is to delay recognizing the full amount of a capital gain until they actually receive the proceeds, if this spans more than 1 year. So it's a calculation that must be completed to determine the maximum reserve that can be claimed in a given year. There are two important points to note. One is the maximum period for claiming a capital gains reserve is 5 years. Second, the prior year's reserve comes into income on the very first day of the next taxation year. So due to the recent changes, there will be situations where you have different capital gains rates which will apply if a taxpayer claimed a capital gains reserve before 2024. So let's look at a corporation with a May 31st year end in 2024. Let's start with 2023. $125 capital gain was realized. The company hadn't received the full proceeds. The company took the maximum capital gains reserve, which is $100. In the May 31st, 2024 year end, the $100 reserve gets brought into income on the first day of the year, which is June 1st, 2023. The maximum capital gains reserve that can be taken for the 2024 year end is $75. So that leaves $25 of capital gains that can be taxed at the inclusion rate, which is 50%. In the May 31st, 2025 year end, the $75 reserve gets taken into income on June 1st, 2024. The maximum capital gains reserve that can be taken for the 2025 year end is $50. This leaves $25 of capital gains to be taxed at an inclusion rate of 50%. So even though the year end is in 2025, the company still gets the benefit of using the 50% inclusion rate, since the capital gains reserve income inclusion occurred on June 1st, 2024, which is before the date of the change, which is June 25th of 2024. In the May 31st, 2026 year end, the $50 reserve gets taken into income on June 1st of 2025. The maximum capital gains reserve that can be taken for the 2026 year end is $25. This leaves $25 of capital gains to be taxed at the inclusion rate, which is now 67%. In this simple example, the company now has to recognize an additional $4.18 of income due to the change in capital gains inclusion. So this raises the question of whether to take a capital gains reserve in 2024. You know the rates are increasing. So by foregoing the reserve, the full capital gain is taxed at a 50% inclusion rate, which represents approximately 9% in tax savings for an individual. What happens if there's not enough cash to pay the taxes? So let's look at another example. A sale occurs on March 1st, 2024, and the proceeds and the capital gains are both $125. The funds received on closing is $25, with the remaining funds of $100 to be received on March 1st of 2029. If the entire $125 capital gain is taken into income, The taxable portion will be $62.50. This will result in taxes owing of $33.46, which is greater than the cash received of $25. I mean, these are small numbers, but you can extrapolate if they were bigger amounts. So in this situation, there would be savings since 80% of the capital gain would be taxed at the 2/3 inclusion rate if a capital gains reserve is claimed. So you need to consider if other sources of cash are available. If you need to borrow to pay the taxes, the interest costs will reduce the overall tax savings. If a capital gain is $1.25 million or less, the maximum capital gain that would be brought into income is $250,000 per year using a 5-year reserve. This would work nicely since the individual could use their full $250,000 annual limit to ensure that the capital gain is taxed at the 50% inclusion rate. Okay, so let's talk about some planning. Up until June 25th of this year, there was a lot of discussions. I was getting tons of calls from clients considering whether or not to crystallize gains. Now, although we're past that date now, you can still make a tax election under Section 5 of the Income Tax Act to trigger a gain. The due date for making an election is the earlier of the filing deadline for either the transferor or transferee. The election form can be filed up to 3 years late and carries a penalty of $100 per month. Now keep in mind that if the election is filed late, there will be interest on the taxes owing, so that could also kind of cut into the savings. There is also the cash flow issue of paying the taxes now without receiving the actual proceeds until a later date. Okay. Now what I've done, I put on a chart on this slide which helps determine a break-even point for crystallizing capital gains. It looks at the rate of growth for the property and the number of years the property will be held. Let's assume that you have a 6% annual growth rate on an investment. You would need to hold the investment for 8 years in order to be in the same tax position after June 25th, 2024. After that point, you will have made up for the increased taxes on a disposition. The hard part, of course, is determining what the actual growth rate will be, because we're not all fortune tellers. If the asset goes down in value, the taxpayer will have overpaid taxes. If a capital loss is realized more than 3 years later, after the crystallization of the capital gains, this is going to be a bad result. You paid the taxes on a capital gain that didn't materialize, and you don't have the ability to carry the loss back to offset the gain. This slide contains some other planning considerations to deal with capital gains. Where possible, it's beneficial to use other family members to get access to their $250,000 capital gains limit each year. You need to watch out for spousal attribution if you're planning on transferring funds to a spouse to invest. So basically, if you were to transfer, attribution just means the income, even though it may have been earned by your spouse, in this case, it would have to get reported on the other spouse's return who transferred the money. You need to consider the impact of alternative minimum taxes. This is a parallel calculation to the regular calculation of income taxes. AMT can catch individuals now with very large capital gains. The good news is that AMT is recoverable over 7 years. In order to use up the $250,000 capital gain limit each year, you could consider transferring assets to another person, corporation, trust, or partnership. The transferor gets to use the 50% inclusion rate. If transferred to a corporation, any future capital gains will be subject to the 67% inclusion rate. You could also make a transfer to a trust for minor children. What's interesting with the tax rules is there's no attribution on capital gains when it comes to children, and there's no tax on split income implications. Each year, the trust could allocate $250,000 of capital gains to each minor, and they could get to use the 50% inclusion rate. There is now a greater benefit of donating public company shares. The tax savings are now 35% compared to 25-26% previously. As a reminder, when taxpayers donate public company shares, the capital gains inclusion rate is 0. no taxes on disposition, and the charity issues you a donation receipt equal to the fair market value of the shares you donated. The $250,000 personal capital gain limit does not come into play here since the capital gain is exempt from tax. Now, since companies don't have a $250,000 limit, there may be a greater benefit to donating shares from a company. You could do a tax-deferred transfer of shares to your company and then donate them. You need to watch out for the donation limit, which is 75% of net income. And any unused donations have a 5-year carry-forward period before they expire. Now make sure to apply your capital losses to make use of the personal exemption rather than using the full exemption. And the goal should be to limit capital gains up to $250,000 in any year. Okay. Now this is my final planning point, and it's basically consider doing an estate freeze. I don't know how many people have heard about it, but when people get older, I would say it's more common when people are in their 50s and 60s for business owners. It's a way to transition the business to the next generation. So the plan here would be to limit any future growth that would attract a higher capital gains tax rate. Once you have the frozen shares in place, redeeming them over time now has a greater benefit. The dividend rate hasn't changed, but you're saving more taxes that would have resulted from capital gains on death. Okay, so that was the first section. I'm going to talk about the lifetime capital gains exemption. Anyone here familiar with this? This is one of the biggest benefits in the tax system in Canada. So now that the capital gains tax rate has increased, the benefit of claiming the lifetime capital gains exemption has also increased. Before this year's budget, as I mentioned earlier, the lifetime CGE was just over $1 million. Starting on June 25th of this year, they moved it all the way up to $1.25 million. Beginning in 2026, the exemption will be indexed as previously applied. So the way it was, I think it was $500,000 for many years, and then it went up to $750,000, and then it's been indexed over the last 5 years, and now here we are. It's already at $1,250,000. And so this begs the question, well, how do you qualify for the capital gains exemption? There are 3 primary tests that have to be met. The first test is known as the Small Business Corporation or SBC test. I'll discuss this shortly on a subsequent slide. The 24-month ownership test requires that for the 2 years prior to the sale, no one owned the shares of the company other than the individual, a related person, or a related partnership. The holding period asset test requires 2 conditions to be met in the 2 years prior to a sale. First, the shares must be a Canadian-controlled private corporation. Non-residents can't claim this. So if you have a company where a non-resident owns more than 50% of the shares, it's not going to be a CCPC. Second, at least 50% of the assets must be used in an active business carried on primarily in Canada. Okay, the definition of a small business corporation is a CCPC in which all or substantially all of the fair market value of the assets are used mainly in an active business carried on primarily in Canada, so more than 50% in Canada, by the corporation or by a related company. Or could be our shares or debts of connected corporations that were small business corporations themselves. Third, it could be a combination of these 2 types of assets. And you might ask, well, what does the term substantially all mean? CRA interprets this to be 90% or more of the assets. It's important to note, we're only looking at the asset side of the balance sheet. We can ignore liabilities and retained earnings. So since this looks at the fair market value of assets, we need to consider unrecorded ones, such as goodwill. For some businesses, this could be their biggest asset, even though it's not actually recorded for accounting purposes. Goodwill, the way to think of it, it's essentially the premium that a buyer would be willing to pay you once you've identified every other asset in the business. It's that extra amount. The tax court has stated that each situation must be evaluated separately to determine if all or substantially all the assets are being used. So you could have a situation where 89, 88% of the assets are being used, and that might be okay. Okay, now let's look at the term active business. And what I find interesting about this term, it's not actually defined. You have to look at what it's not. And so it does not include a specified investment business or a personal services business. A specified investment business is a company that is earning passive income, so think dividends, rent, interest, etc., and they're less than 5 full-time employees. In certain situations, you could have lease income treated as active income. Some examples could include running a business where you're leasing vehicles or equipment. A personal services business exists where a company is created by an individual who performs all the work, and the individual would normally be considered to be an employee of the payer. Okay, we're going to look at specific assets that get examined to see if we have an active business. And this is an exercise that I do regularly. Cash is usually an important consideration, especially when you've got a large balance. You have to ask the question, is it really necessary to carry on the operations? If the cash were removed, would it have a detrimental impact on the business? You also need to consider seasonal swings in a business, since cash might build up at certain times of the year. I generally look at the current liabilities of a company. If the cash balance exceeds the current liabilities, there's a presumption that you have excess cash. If you need to pay a management bonus, the cash could become active. Remember, you need to actually pay the management bonus within 6 months of the year end. I've had clients in the past that have taken the position that there's a valid business reason why they need to maintain a higher than expected cash balance. In those cases, it made sense, and they filed on that basis. When you have investments, they're typically viewed as passive assets. Now, there's some exceptions listed on this slide. If you're using investments as actual collateral with a risk of loss, this could be viewed as an active asset. This is different than simply pledging investments as collateral. If you have seasonal swings in your business and invest excess cash in something like a GIC, that could also be viewed as an active asset. Insurance policies are another asset that are typically not active. From a valuation perspective, we use the cash surrender value. You need to ask, why is the insurance there? If it's life insurance, it's likely not an active asset. If the insurance is there to replace inventory or business assets, it will be treated as an active asset. Balances owing from related parties are often passive assets. And we see this all the time. There's often more than one company in a chain, and then you have to look in. Like, in order for that loan receivable to be active, the related party must be meeting the definition of a small business corporation on their own. So you have to then check the financial statements of each company where an intercompany receivable exists. So let's look at an example of a company with only 2 assets on its balance sheet. There's $400,000 of cash and $400,000 of goodwill. Obviously not realistic, but let's just run with it. There's a management salary payable of $350,000. Is the 90% test met? Well, yes, because we can say that the $350,000 of cash is needed to pay the management salary payable. The second test for getting the capital gains exemption looks at that 24-month ownership period. The shares must be owned by individuals or related persons. Transfers between family members are okay since everyone is related. Planning can be done to intentionally fall within this when a share sale is expected within 24 months. You just have to watch out again for attribution. If shares are received as part of a divorce settlement, that's okay. When a trust holds shares of a private company, this is okay since the trust is deemed to be related to its beneficiaries. In fact, this can be a very powerful way to multiply the capital gains exemption. And there's a lot of planning where we do this. If you have many beneficiaries, each of them is going to get their $1,250,000 of capital gains exemption. If the gain's big enough, you can pretty much reduce tax to nothing. And remember, a partnership is related to a person who is a member of the partnership. Now, there's some tricks and traps to watch out for. When a company is newly incorporated, the shares would not normally meet the 24-month test. However, there is an exception that allows a sole proprietor to roll over their business assets or a partnership interest into a new company and claim the capital gains exemption, even though that the company has not been around for 24 months. Another exception occurs where shares are exchanged for shares of the same company. You need to be careful when there's a freeze. In these situations, new shares are often issued to a trust or family members. Those shares need to be owned for at least 24 months. However, if those shares were transferred by a related person, you don't need to start a new 24-month period. Here's an example of a holdco structure where we want to determine the 50% active business test. In this structure, holdco owns 100% of the shares of opco, very common structure. Opco has $25 of investments and $26 of active assets. Holdco has $49 of investments and $51 representing the shares in opco. When you look at the total investment assets, $74 out of the 100 are passive. Since 74% of the assets are passive, holdco won't meet the 50% test. You can have a tiered structure where one company has more than 10% in non-active assets. However, all other companies must meet the 90% test. You also need to ensure that the 50% test is met throughout that 24-month period. Okay. Clients will sometimes come to me, and it's funny the way it happens. Ideally, and there's some proactive ones that do it well in advance, but many times people will come up to me when they have a sale offer in hand, and they say, oh, do I meet the QSBC test? So the issue with a lot of them is they'll meet the 50% test, but it's the 90% test that's the stumbling block. The points listed on this slide are all options for purifying a company that have excess cash. Some of them are operational decisions, such as reducing liabilities, buying equipment or inventory. Other options include paying dividends or bonuses, which could result in taxes, which have to be weighed in the situation. Okay, last but not least, here's some items that you need to be aware of. Numbers 1 to 3 can actually reduce an individual's ability to claim the capital gains exemption. Enable refers to a special type of loss on small business company shares or debt. A CNL is cumulative net investment loss. That occurs when the total amount of investment expenses that were claimed in prior years exceeds the cumulative amount, so all your net investment income over all those prior years. If the excess is a negative amount, a loss, then you have a CNL problem. Very often when taxpayers claim the CGE, there is AMT, which can be a nasty surprise since the expectation is you're not going to be paying any tax. Good news is AMT can be carried forward up to 7 years and applied against future taxes. You just need to have enough sufficient income in those prior years. So to the extent you're paying just regular taxes, the AMT will reduce that amount. US citizens are listed here since the capital gains exemption is a Canadian concept. When they file a US tax return, they will have a regular capital gain and pay taxes. There is no ability to use the foreign taxes paid on the Canadian return since the capital gain is exempt from Canadian taxes. Okay, now the Canadian Entrepreneur's Incentive. This is a brand new concept that was introduced in the 2024 federal budget. It's effective beginning on January 1st of 2025. Similar to the capital gains exemption, the C operates as a deduction in the calculation of taxable income. The CEI is equal to 50% of the taxable capital gain for an eligible gain. For 2025, it only applies to $400,000 of capital gains, and each year thereafter, it will increase by $400,000 until it reaches a lifetime exemption of $2 million, which will happen in 2029. Okay. The definition you need to know is qualifying Canadian entrepreneur incentive property. These are shares that would otherwise qualify for the capital gains exemption. We just covered this topic, so I'm not going to repeat the details again. But a key difference is that the shares must be owned directly by an individual. So you can't have a trust owning it. Therefore, if you have shares that are held by a trust, they must be distributed to an individual before a sale. The holding period test will be taken into account at the time that the trust held the shares. So that's good news. Now, please note for the 24 months prior to the sale, the individual must own at least 5% of the fair market value of the shares having full voting rights. So therefore, you could have a minority shareholder who takes advantage of the CEI. The final requirement is that the individual is actively engaged on a regular, continuous, and substantial basis in the business for a period of not less than 3 years. And if that sounds familiar, it's borrowed from the tax on split income rules, so basically preventing income splitting among family members. What does that mean? It basically means that that individual has to have worked in the business for at least 20 hours per week during which the business operates. And it doesn't have to be 3 consecutive years, it just has to be 3 total years. Okay, now the CEI, what's interesting about this one is the government picked winners and losers. They made a list of all these excluded businesses, which includes the industries where it doesn't apply to. When you look at it, it includes your traditional list of professionals, consulting businesses, and financial services. The industries listed on this slide include insurance and real estate services. And on this slide and the next slide, we're talking about tourism and hospitality services. To be honest, I'm not sure what the rationale was for excluding these businesses, but there's been some pushback from these industries. Okay. Now the maximum deduction for CEI purposes, it looks a bit strange, but it involves 2 calculations. For 2025, you start with a $400,000 capital gain limit, and you multiply that by the new 2/3 inclusion rate to get $266,667. Next, you multiply 266,667 by 50% to get your maximum deduction of $133,000. At the end of the year, your taxable inclusion is $133,000, or 33% of the total capital gain. This is better than that 50% inclusion rate where $200,000 would have had to be brought into taxable income. You can see by 2029, when the capital gain limit is $2 million, the maximum deduction is $667,000. Please note that adjustments may need to be made when the capital gains exemption is also being claimed. So let's look at an example of a 2025 disposition of CEI property. Assume a capital gain of $1.8 million and the full capital gains exemption is available. The taxable capital gain is $1.2 million, which is $1.8 million multiplied by 2/3. The maximum capital gains exemption is $833,000, which is $1.25 million multiplied by 2/3. The maximum CEI is $267,000 for 2025, which we just saw on the previous slide. But before we calculate the maximum deduction available, we need to remember that the total annual gains limit is $1.2 million. Our deduction cannot exceed that amount. The net result is a maximum deduction of $967,000, which is $833,000 plus $133,000, which is half of the CEI of $267,000. Therefore, on a $1.8 million capital gain, the total amount that will be brought into income is only $233,000. Okay, this slide outlines the implications of failing to report a capital gain. There is no CEI deduction if the individual knowingly or under circumstances amounting to gross negligence either failed to file the return within 1 year of the due date or failed to report the capital gain in the tax return for the year. In addition, the CEI deduction could be denied if the minister established the facts justifying the denial. Now, for most law, I just want to say, gross negligence is a very high bar. And the government sometimes throws it out, or CRA sometimes throws it out there, but it doesn't usually stick. So I would say for most law-abiding citizens, you can't file a return more than 1 year late and still claim the CEI deduction. The potential out is if this was not done knowingly. Similar to the CGE rules, the CEI has a 24-month holding period test that can be met if related parties own the shares. All of the situations on this slide would meet the holding period test, despite the fact that the shares owned by the individual may have been for less than 24 months. Okay, and so that is the presentation, and I will open the floor for questions.
No questions, guys? Come on. You got to throw them a question. You know what, Daniel? It was an awesome presentation. I think the people in the audience probably were a little bit overwhelmed. There's a lot of information. I was wondering how many pages you were going to flip, to be honest with you. But again, thank you very much. I really needed a beer before I came up to the stage. Because
you know what? You send the presentation to the attendees so they have that for their.
No, I'm just teasing.
Yeah.
This is just a tease. I'm just making fun with you. Honestly, guys, listen. Let's thank Daniel. Honestly. We're not that smart. We're HVAC contractors. Okay. I will tell you that whatever he's talking about obviously is overwhelming. We're going to have a quiz just before you go to the bar, though. Okay? So that's why we have professionals like this. That's why customers call us to fix their stuff. They don't know what they're talking about. A lot of times we don't know what we're talking about. I just recently went through this, and my head's still spinning. So again, thank you very, very much. If anybody we got a question here. Hold on a second.
Yep.
Personal wise, I heard there was a rumor out that if you own a vacation property that you rent out, you're going to have to pay capital gains. Like if you own that property, you still rent it out. It's not like it's your own home. It's not.
Yeah.
You were going to have to pay capital gains on that because it now becomes a business. That's what the rumor was. You heard all of that?
Not that in particular. I mean, if you're just renting it out casually, I mean, if it's not that organized, if it's just someone who's just renting it out, I mean, for the most part, I don't think so.
It's not your primary residence, though, right?
No, it is my primary residence, but I can stay somewhere else and rent it out.
Yeah.
Like a lot of people are doing.
Right.
The younger generation will stay with their parents, buy a condo, Airbnb it out.
Yeah.
Now I heard there was a rumor that property now becomes like a business, and you'll have to pay capital gains on it when you go to sell.
Oh, no. So if it's the business part doesn't change anything. If it's treated as a capital gain, that would have always existed. So basically, when you have two homes, you have to make a choice whether you're going to claim your principal residence, which one you're going to claim, like the city home or a cottage. But what's important is when you actually change the use, when it becomes a rental producing property, there's a deemed disposition that it's no longer personal use. And so you actually need to report that at the time, but there's a tax election where you could make the argument that a change in use didn't occur. So it's a very specific fact pattern, but at the end of the day, it will be a capital gain.
One of the interesting things with the election recently in the States, one of the dirty rumors was they were going to tax unrealized capital gains.
Yeah, I heard about
so
that. Yeah.
I don't know if anybody heard that, but and I've heard this with the Liberal government here, that they've looked at it and the potential for generating revenue. So basically what that means is, so you have an investment, maybe you can explain it.
Yeah, so if you have an investment, let's say you bought it for $50,000 and it's gone up to $100,000, you're in the money $50,000. If they were to tax that unrealized gain, you'd be paying tax on a $50,000 profit, although you never received the cash for it. So, I mean, it's a rumor. I mean, I think anything...
You don't pay it off later? Like, how does that work?
I mean,
So these are the rumors.
it's a rumor.
So.
There's no details. It's just speculation. I think I don't want to sound political, but with this government, there's been a ton of tax changes, and it seems
Which
like...
government are we talking about here?
The federal government in
Okay.
Canada.
The Liberals.
Yeah, the Liberal government, yeah.
Just one.
Yeah.
Wasn't sure.
There's been a ton...
If you pay your lifetime
Yeah, I mean, theoretically, yeah. But I mean, it's just a rumor, but I think a lot of, anything could be on the table. I mean, whether it's a wealth tax,
Primary residence
getting rid of the
tax.
primary residence, like anything, like we've seen so many changes. It's like, as accountants, it's been hard to keep up with the changes.
The best part with that unrealized part is they'll tax when you've earned some possible income, but then don't take into account necessarily that you've paid that in advance, and if there's a loss later, it makes it very difficult, right? So you've paid in advance something and then have to then claim a loss later.
Yeah, because I mean, you only have 3 years to carry back a loss. And so
Right.
if it's past the 3 years, you can't offset the gain.
Governments are generally only in for 4 years, so they don't care, right?
Yeah,
So, anyway, that's my political spiel.
But that's not tax law,
Done.
so it's just rumors. There's
Yeah.
a lot of rumors out there. So yeah, this was just to kind of get you guys up to speed with, because the capital gains change, that's a big deal. And it hasn't passed into a law yet, so there's all kinds of uncertainty. The government's kind of on shaky ground. We were thinking originally it was going to be later this year. Now maybe early next year, but who knows? Like if the government, if there's a non-confidence vote, this thing may never pass. But for now, we're operating on the assumption it will.
Yeah.
Yeah?
So like if you have a business and your wife and kids are in the business, then you sell it, does everyone get that 1.2 million exemption?
You have to be a shareholder. So
Yeah, like if you're all,
if everyone's a shareholder and it meets those tests, as a small business corporation, each person can claim that 1.25 million capital gains exemption. So that's why like the whole idea of multiplying is so powerful. And so some people will set up trusts and you can name all kinds of beneficiaries. Like I had a client, they claimed 8 capital gains exemptions. So it was tremendous, the savings.
So you need 20 based on that 1.25, right?
So, Daniel,
My-
is this the kind of thing that the next government might reverse or change, since it seems to be fluctuating year by year anyway?
It's a great question. The problem, I mean, remember the Liberals actually did something highly political, and they did not include this as part of the larger draft legislation that came through, or a larger bill. They put this as a standalone bill to put the Conservatives on the spot, to force them to take a stand, because they didn't want to do that. And then Pierre Poilievre said, no, we don't like it. So is it possible? Yeah, I mean, if we take what he said and what most Conservatives feel, they don't like it, but we have to be realistic. Canada has tremendous debt, especially from the COVID. And how are they going to pay for it? So it's one of those things where if the bill's already in law, they won't say, well, we brought it. It was the previous government. So it could be something like that. However, if it doesn't pass, then it would be interesting to see if it would move forward.
No other financial or political questions? Remember, get out and vote. Just vote, and as many times as you can. Anyway, again, thank you very much. Appreciate it. Right here. That's for you.
Oh, thank you.